This is David Goldman, Asia Times Deputy Editor, speaking to you from New York the evening of March 25th. Is it time to buy Chinese stocks on the dip? Since their February peak, the broad Chinese indices are down 15%, and tech stocks are in a bear market, down about 25%, measured by, for example, the performance of the popular exchange-traded fund KWEB. Well, to put things in perspective, if you look at the chart, even after the February-March tumble, Chinese stocks have still outperformed American tech stocks. For example, the NASDAQ, KWEB is still about 8% above NASDAQ returns for the past 12 months. So what we've lost is a few weeks of blow-off earlier in the year. Returns on a 12-month basis are still quite handsome. Citigroup today put out a report to clients strongly arguing that it was a great time to buy in the dip, recommending beaten-up names like Tencent, Alibaba, Baidu, and JD.com. Now, there are four things that went into the tumble in Chinese tech stocks. Some of them we have a strong opinion about, but I have to say some of them remain quite uncertain. To start with, Chinese tech stocks tend to trade in the same direction as American tech stocks, though not by the same amount. Secondly, we've had antitrust measures against some of the Chinese tech giants, which worried people that perhaps there was a witch hunt going on by the Chinese Communist Party against entrepreneurs. Third, the Securities and Exchange Commission has imposed tighter accounting standards on Chinese stocks that are listed on American exchanges, and there's some fear that these stocks might be delisted. And fourth, and in my view, by far the most important, there is a nasty strategic dust-up going on between the United States and China, as reflected in the acrimonious exchanges in public at the Anchorage, Alaska summit last week between Tony Blinken, America's Secretary of State, and China's Foreign Minister Wang Yi. Now let's dispense with the easy stuff. The antitrust measures which China has taken are actually quite reasonable. Monopolies lead to abuses. We've seen that in the United States. It's simply that big tech has too much political power in the United States for anyone to go after it. The antitrust measures we've seen are reasonable and far from designed to hurt the big tech companies. On the contrary, China's strategy to move up the value-added chain through high tech depends on the likes of Baidu and Tencent and Alibaba. The Chinese government does not want to kill the goose that lays the golden egg. It's only negotiating with it. As for SEC delisting, that is more or less threatening to throw Chinese companies back into the briar patch because they can get all the financing they want in Hong Kong. In fact, out of the $140 billion of IPOs raised by Chinese companies in 2020, barely over $10 billion was raised in the United States. So Chinese companies are not really dependent on the U.S. market, and I don't believe that the Securities and Exchange Commission really is going to delist many Chinese stocks. That's simply a holdover from a symbolic move by the Trump administration. However, there is a possibility of serious strategic miscalculation between the United States and China. China's sense of its own power and importance is growing, and China could easily overreach. For example, the decision to sanction individual European politicians over criticisms of China's treatment of its Uyghur minority in Xinjiang province provoked some shock in Europe. In my view, it was an overreach. It wasn't necessary. The Chinese are still hurting over American efforts to boycott technologies that China needs, particularly high-end computer chips and chip fabricating equipment. And we saw the kind of thing that China might do in a campaign on social media over the last week to boycott Western brands like Nike and Marks and Spencer's because They've been involved in criticism of Chinese policy in Xinjiang. They haven't been buying cotton grown in Xinjiang and so forth. So the possibility of strictures against American companies in response to American economic measures against China is something to worry about. I personally do not believe it will come to that. The big tech constituency around the Biden White House remains enormous, and big tech doesn't want to scrap with China. It wants more entry into the Chinese market. So I think the likeliest scenario is that this will de-escalate, and it will turn out to be a great time to buy Chinese tech stocks in the dip. The Citibank recommendation will turn out to be right. So with a strong caveat that we're dealing with a political uncertainty here, I think it is in fact time to buy Chinese stocks on the dip. This is David Goldman, Asia Times Deputy Editor, speaking to you from New York.